Welcome, everyone. Welcome to the Foundation for the Study of Cycles and our Cycles TV episode for today. We have Monday, we have Cycles time. So as you know, once a week, we discuss the current status of different cycles, different data sets, just based on the current data. And for today, we have a special guest. So in a second, we will bring in a colleague and then discuss it. But before we start, have you been part of our 80 years anniversary for the last days? Have you seen all the great content which we have produced and streamed in the Science Summit and the Market Summit we did? If not, there's so much content out there, and I want to recommend just review what we have. Lots to learn on cycles. So today, what we're doing here. So if you are new to this session, once in a week, we will meet here at this place and discuss the current state of cycles in different data sets. So we are here for the analysis of cycles, and then you can evolve your own analysis based on market forecast, what it means into your trading environment. And to get it started, I want to introduce our guest for today, and I'm happy to have Mark Newton here with us for today. So Mark, I mean, you're an expert for over 20 years. So you are especially a market technician. You have been a floor trader, options trader on the stock exchange. You have worked as technical analyst, even for Morgan Stanley. You have your own advisory. You are showing up on shows like CNBC and Yahoo Finance. So you are a real market technician, and you are applying all this technical analysis stuff to the stock market. So, and I'm really looking forward to this session to talk to you about how cycle and cycle analysis influences your job as technical analysis. So welcome, Mark. Please introduce yourself, and please let us know, how do you use cycles in your daily business?
Hi, Lars. Yeah, thank you very much for having me on today, and thank you to the Foundation of the Study of Cycles. I've been a market technician for the last 20 to 30 years. I've been involved with the financial services industry on the buy and the sell side, and trading equity options out in Chicago. And then I worked as an analyst at Morgan Stanley in New York, and I worked with a hedge fund. And I started my own firm, Newton Advisors, about 4 years ago, pre-COVID. So a lot of us have been pre-quarantining here for quite some time. But look, it's always been a pleasure for me to be able to look at markets. It's a passion of mine. I've always used time in my work. I always looked at the works of Dewey and Hurst and W.D. Gann, and I've always been fascinated with how markets move, and that there's certain rhythms to the movement, and obviously trends, and that things aren't just stochastic, that there are very well-defined trends. And so, cycles have been at least a minor part of what I've used through the years, but I think through the work, or your work, and through the Foundation of Study of Cycles, you created something that can make that a lot easier, I think, for the layman to pick up, to use. And I think that cycles in general are very important part of how to look at the world. And we see them in all walks of life. So basically, I've just, to talk about cycles a little bit, I started using them probably 20, 30 years ago, and I fine-tuned it a little bit. And I used to just do cycles based, from scratch, and looking at, periods between low to low and low to high, and trying to figure things out. But I never really, smart enough to be able to automate it or do anything computer-wise. And so I think what's interesting to me is that, by utilizing what the foundation and what provided, it really allows somebody to back test and look at different cycles and really tend to fine tune how you use them. So really what I want to do is just initially, show you some of my work and show you how I tend to use the cycle finder, which I think is very interesting and, extraordinarily helpful to my work. So yeah, what I will do is sort of share my screen, and then we can talk about how exactly I use it and really my methodology and my process. So what I'll do is just sort of share my screen, and then as you can see, you'll see We'll start off with Bitcoin only because I think this is fascinating. It's certainly an area of interest to many people these days as cryptocurrencies have really moved into the mainstream, and institutions have increasingly begun to embrace this technology. And so this is just a chart going back over the last few years. The way I specifically use a cycle finder is I try to find many different time frames. I think that's really important. I think that just looking at a daily chart over 3 years, it can be helpful, but when you combine it with a daily chart going back for a duration of 10 years or 20 years, and also look at weekly cycles, they really tend to help things to add to the probability of your success. And so
Yeah,
I
Mark.
tend to rank. Go ahead.
So before you go into this chart in specific, so I mean, you started with you use from your technical analysis point of view cycles for timing perspective. I mean, before we dig into this concrete chart and setup, what are you looking for using the cycles? And if you say you start with longer time frames and shorter time frames, so can you start a little bit about that?
Yeah,
How
well,
this?
for example, I typically use a lot of different techniques in my own work based on momentum, based on sentiment, based on seasonality, based on counter trend tools such as the work of DeMark, and who was a guest of yours last week, and also Robert Prechter, making use of Elliott Wave. So I use all of these techniques in my work, but I try to use the cycle finder specifically as a way to try to add confluence to my thinking that there could be a change in trend or a turn. And so if I have a number of my different indicators that are all saying that the trend is reaching exhaustion and that we can turn down, then I would look at the cycle finder and try to find, see what that also is suggesting. Is that also an additional piece to the puzzle that might suggest that trends could be on the verge of turning?
Yeah,
and
thanks for
your question.
Yeah, thanks for bringing this up, because I think this is an important topic also to always keep in mind, that cycles is and should not be the only point of truth you're looking for if it comes to market forecasting, or then integrating that into kind of trading and market analysis. So it just complements or brings another view to timing. So and I think this is what I always, or we start with cycles, but I think if you're in the markets, and especially if you're a pro in the trading era, you start with your own setup you have, and then cycles can guide you in regards to timing. So just thanks for bringing this up, and now maybe let's go into your Bitcoin chart for sure.
Yeah, I think that's an important point. If I could just add one more thing, I mean, looking at the markets over the last year, it's been a really crazy time for financial markets, and really we've diverged substantially from what the broader economy has shown. And so, sentiment has been wildly optimistic lately, but yet we really have seen no evidence of change of trend. So, as you mentioned, it's really an important piece of the puzzle, and is something that we should use to really complement it, because price and time in general are the most important things. And when they hit certain junctures, then we can see changes of trend. But price obviously has just been straight up. And so to look at sentiment and say, well, things are going to turn, maybe yes, maybe no, but it's really important to wait until you get confirmation. And so that's why cycles, I think, can really help us really to add to the probability of success. So the cycle finder, I looked at Bitcoin over the last 6 months using this cycle finder. I've been involved, over the last few years in and out, and just trading it for my own personal account. And specifically, I wanted to show you this graph because, as you can see, the right hand has actually not been filled in. I did this as of right around the beginning of December, and I saved it as a workbook. And as you can see, the trend is actually moving up. And if you look at what I try to do, how I utilize it is by sorting not only by strength of the cycle, but also by Bartel score. And I think that really helps one to find the absolute best number of cycles. And so as Lars, as you've probably explained to your audience before, when you go down to the bottom part of the screen, you have your spectrum, and you can oftentimes identify very quickly and easily, for those that are more visual, cycles, say, by the length of 273 trading days. And that has a very high Bartel score in the upper 90s. Other ones, 132. You see some other ones. So the ones obviously with the highest Bartell and the highest strength would certainly be the ones that we would utilize for this. So, I had selected a certain number of ones, and I recognized that, many people have been calling for Bitcoin to go down for some time, but the cycles actually, when you use the highest strength and the highest Bartell, you see that they really don't begin to turn until the middle part of January and turn down.
Yeah. So thanks, Mark. So before, I think this is an interesting chart because important to you to mention it. I think the analysis ends in December last year, right? So
Yes.
the dark. So this is important to mention. So I think, and as you mentioned, you have observed, I think, for months to come. So this is also something I try to tell or bring across the line here, so that you should not apply cycle analysis just once, and then hope now I have the forecast for the next 2 or 3 years. You need to do this kind of in your daily routine, and then check if your composite or the cycles you have selected here are kind of stable or repeating. So if they show up from day to day or week to week when you update or review your saved workbook, I think that's interesting. And I think what you show here is that this from December last year, it showed at least the peak into the January period here, right? Which
Correct.
Yeah.
Yeah, so I thought it was interesting here and really important to include the run-up that we saw into late 2017, because that is a huge move, and it certainly will have an influence on the amplitude and also some of the other cycles that will be used in this process. So it is important to look at different time frames, and so I can pull up some different examples of really Bitcoin and show you, some of the other ones that also I was looking at. And so here's one, for example, just since 2018, and this also shows a pretty prominent peak. And so, many times it can be insightful to utilize these shorter term durations for the cycles on daily charts and also look at longer ones like I use. So in this daily example also, we have, and I'll just refresh the data. You can see that the 187-day cycle has a Bartell score over 90. And the next one I used was 46, which is also a very high strength score. So this is, if I sort them by strength initially, then I look and see. So I wouldn't want to use one that's only a 15, which is a 40-day, but I want to use, something like 46, which has a high strength score and a high Bartell score, and also use, for example, 61 likely would not be used. And so I'll just refresh this because it's been a while, and we can see what comes up right now. And that would help us to sort of have a good idea of what we would use. And so, we have 187 days, we have 46 days. We look back, here's one of 112 days. And so here's also an example. So using these three, and the dominant cycle right now is showing to be 40 days. So you remember when I talked about that a second ago, that wasn't showing, the best Bartell score, but that does appear to be the dominant cycle. And so, we've seen that initial turn down. Here's the dominant cycle turn down from early January and into the latter part of January, which we've seen. So this last month has been, lower. And I've always found in my studies that when the dominant cycle lines up with what the composite shows, then you have a much greater chance of success. So in this case, both the dominant cycle and the composite turned down in early January. And in this case, the composite stays lower, in this case, until March. But this actually shows the dominant cycle turning up. So I would think the greatest period of the next acceleration down would likely be from the middle part of February down into March.
Yeah.
Specifically just using that. So we've seen two examples. If I can, I just want to show a third very quickly, because I think that as we talked about, using them on a weekly basis, also you want to change timeframes at which you use things. And so here's another example where, Bitcoin on a weekly basis, and this just goes back since 2015, but it shows things on weekly time frames. And so you see these ones that I've selected. Here's a 15-week, there's a 98 of Bartell score. The other ones are 76 and 37. These all have very high strength ratings, and they have Bartell scores that are, this one is I think as you taught me, and as other people might come to understand, anything over 60, if it has a different type of length, is going to be useful. But you don't want to have too many
Yeah.
cycles that are too close in duration, or that are too long term, maybe where I'm only using 5 years. So I don't want to have a 500-day cycle if it's only a 5-year study. But I also don't want to just only look at the smaller cycles. I sort of want to have different lengths that are all strong, that all have the high Bartel scores. So here also you see that we've turned, not only were this stalled out in the middle part of the summer of 2019, early part of 2018, and now it shows a very prominent peak early part of this year. If I look back over the last 10 years and not even looking at this, you look at the years when we had very strong fourth quarters, 2013, 2015, 2016, 2017, all the first quarters of the next year ended up being weak. So I've used the cycle finder to actually take profits, and I'm out of cryptocurrencies 100%. And I'll revisit them when it's time. But it's interesting in that the cycle finder gave me the ability to get out of that before we heard that Yellen, who's going to be joining, of course, the new administration, might have plans of some higher scrutiny and regulatory measures to really come down on cryptocurrencies. And so the fundamentals, could in fact join the picture for a bearish move over the next few months.
Mark, thanks. Maybe just you mentioned this slightly already. How did you integrate this view into your classical view to Bitcoin? So you mentioned a little bit it helped you to preview this. So you used these analysis for the last weeks, but how do you combine this with your tools? So from your perspective,
so as I mentioned, I look at a number of different things, and so momentum for how I look at the world, had gotten very short-term overbought. So we saw very high RSI scores, or relative strength index, for daily and weekly charts of Bitcoin. I also saw, by the works of Tom DeMark, his DeMark indicators also started to flash confluence that we could, in fact, be nearing exhaustion. So I had two pieces of the puzzle, and now I just looked at not only daily but weekly Bitcoin cycles, and they're all starting to show evidence of peaking out and turning down. And so, I looked at my personal, the last 10 years, and the fact that the fourth quarters were strong, the first quarter was weak of the years when we had a big run up. And I said, you know what, the final piece of the puzzle, at least for me personally, was sentiment. And so I looked at Google Trends, and I looked at the number of internet searches for Bitcoin, and we saw that they all had spiked up to levels that we hadn't seen in at least 3 years since the 2017 peak. And so here we have a number of different areas that are a confluence of sentiment, momentum, cycles that are all suggesting that Bitcoin could be a near peak. So, when you put that together, it just seems like a very poor risk reward. And of course, we have to let the prices turn. So what I did personally was just sell half of it right around the 8th, 9th of January, and I left a trailing stop for the balance of it. And of course, I got taken out of those stops. And so, now I have zero exposure.
Yeah. Thanks, Mark. This is great insight in how you apply it. And I think what you show here is what we try to teach anyhow to the users of the cycle analysis. So it's a very nice example of basic usage. Yeah. And if you like, I mean, we talked about Bitcoin. Maybe do you want to share some other data set with the?
Sure. Well, I just showed the S&P. I have a couple other things I want to talk about. And so, if we can, as it's loading. The S&P I also looked at on a daily basis and also a weekly basis. And so this data goes back actually since the late 1920s. And so it successfully timed an area where the market actually turned down during the Great Depression back in the late 20s. Of course, the 1929 crash. This, successfully show the lows happening right in 32. And so you go over the years, and we've seen some of the major, sell-offs and also bottoms that we had the period of time in the mid 70s when the market corrected almost 50%. And this, the cycle timer showed the weekly cycle is having aligned very, very accurately with that. And so even in the last, 20 years, we see that both the 2000 peak and also the 2007 peak directly aligned with this weekly cycle. And also, it showed it's turning down in 2014. And of course, the market went sideways for about 2 years. And now it shows us turning down again. And it could, in fact, if this is any guide, this is just a weekly cycle, but this will show us selling off potentially into, the middle part of next year. And so,
Mark, this is very interesting. You're very fast here. So you're showing a very long-term chart of the S&P on a weekly data set, right? So you're using our Yahoo wrapper to pull up the weekly data. And I'm just looking, you have over 4,000 weekly bars. So this is a really very, very long period. And I like this chart because this is also a good starting point. So starting with this long-term view, I mean, this is a very long-term view, but what you did, and if you scroll back a little bit into the past, you scrolled over it very, very fast. I think what you did is you checked if the selected composite cycles you have pre-selected here line up with important bottoms and tops in the market, right? So maybe stay on that. Yeah, exactly. As you show here. So we are now
let's look back at the mid 70s. So in 73, this pinpointed the high and it sold off into 74. In the late 60s, this pinpointed a high in 65, 66. Of course, the shorter cycles, we look at those too, but it shows in general the cycle was down. It showed a period where we moved up from 1932 and then we actually turned down into 40. And so it's fascinating to me to see that these still sort of stand the test of time, that these are still very, have been very, very good. And so many people recognize the time period of 182, of course, with W.D. Gann and looking at 180, half a circle.
And so this is fascinating. So you have a 100-year chart here, so which is great. I like it. So, and I think this is a very interesting starting point just from a longer term perspective. And I don't know, how many cycles have you activated on the composite? 3, 4? I think it was.
That was 4 on that one. Yeah, but you can go back and see different. And so I'll just look at, here's another one on the S&P. And I just want to show you this also because this is pretty interesting. So this just goes back. Let's see. So here's I have several different ones of these that I've saved. One goes back since 2017. One goes back since 2015. This one goes back since 2010. And so this helps. And I'll have to refresh this data. As you can see, I took a snapshot of this on 10/28 and showed the market actually rallying into the middle part of February before turning down. And so what I always like to do is see how it did in the past, and then I'll simply go and sort of refresh it and then make sure that those cycles are still the ones that I want to use. As you know, and as you've taught to others, cycles do in fact change with the phasing, and they can become different. And so, we see that the stronger cycles right now are like a 32-day, but looking out over, you always want to get a longer time frame. And so we see that 372 and 281 and maybe 157 are the ones at a snapshot. So 157 has a Bartel score of 84. The 281 has been very important. And so let's turn on our dominant cycle and we see that's 119 days. So even here, this is interesting, and it shows you, this did peak, of course, a little bit earlier than when markets peaked this time last year, just specifically based on this 10-year view. But it shows that the market is sort of choppy. It rallies into January, and then it sort of double dips. But between February and in May, specifically because of this does show a downward bias, and so that's interesting.
Yeah, and I think it confirms more or less the analysis you have shown before. No? So it just updated to the current data, and in regards to the general outlook, it is in alignment as what you've shown and done, I think, in October. So
there's one final thing that I'd like to really highlight, and that I think it's important not only to look at equities, but look at other things that might show the same degree of confluence. That might just add to the probability of success, that using a completely different data set. And so this is something just based on the St. Louis Fed Financial Stress Index, which you showed, I believe, a few weeks ago, in our weekly chat here. And it shows that, and this is not based on equities at all. This is based on 18 different data sets based on 7 different interest rates and a number of different yield curves. But interestingly enough, this showed the peak into 2009 when the markets, of course, bottomed. We had the giant bear market from 07 to 09. This also showed a sell-off into early 2016. So for many that are involved, they know that the market peaked out in late 2015, and we had a very vicious 10 to 15% decline into early 16. Now it's showing this is turning up yet again. And so I just want to highlight for viewers, the cycles that were used in this process to try to, and so I looked at, this is going back since 1993. So also here, it's a lot of data. And we see that, this one right here, it has a Bartel score of 87. It's 384 days. So that's certainly something I would want to use in my analysis. But also I use one here, which has 101 days and then 59 days. And so as you can see, the lengths of the cycles are all, they're all different. 59, 101, the length, 384, but they all have good strength scores. They all have good Bartel scores. And so when you combine those, you see that, this is headed really straight higher into 2023. So, the combination of looking at equities along with fixed income for evidence of financial stress would suggest that, the weight of the evidence points that we actually could have a bear market that might start this year.
Yeah. So, and now you should go to the daily chart, but you showed your cycles here. So it looks like that the period starting now around February, where I showed your daily cycles, is also pointing out. So, combining your 2 analysis you showed are quite bearish for Bitcoin and the markets, right? Just based on cycles.
Well, I would say the period between now and the spring, summer is going to be negative for Bitcoin, and for S&P, that we should have a turn that could start really anytime over the next few weeks. It should at least turn down initially. There's some other charts, and I think it's worthwhile for users to just take a look at the different data sets, because there are some S&P charts that do point up until April. And I know there's a few of your guests last year that ran some cycles based on the YouTube, the presentation that many of the presenters did back in May, I believe, for the Foundation of Study of Cycles, that pointed up into, the spring. And so I wanted to also do that. And I looked at just a cycle going back from 2017. And this actually does show, a peak into the spring. And that was based on the 175-day cycle. Many might remember I showed that on Twitter and other places, and that it did show a downward bias from October through December. And so, I wasn't sure if that had actually changed, and that cycle was no longer relevant anymore. But so these are the cycles that I'm using for this, and that, let's just refresh that. So this goes through the 22nd. So just for the purposes of everybody, I think it's important to always start and see with the most recent data, and then do a study all over again to make sure we're always involved with the highest strength and the highest Bartel scores of the cycles. So here's the highest strength scores, and we see that really not a whole lot of them really give us great Bartel scores. You have a potential of one that's 32 days, but really it's just 173 that really comes up as having a strength of over 2 and close to a 90. So specifically based on the last couple of years, this is showing as being important. Go ahead.
Now, I think what's interesting, and we watched this cycle with the lengths of 170 something regularly for the last year, because this cycle length showed up almost during the last year. And what you mentioned is since September, October, or if you just activate only the one with the 170 something and disable the other ones for a second, because I think this is maybe interesting to talk about. Yeah, and it has gone out of sync since the October period, no, where it's still pointing down into the December, and the market kept moving up. And I mentioned this here also in our discussion. It happened around the midpoint of the cycle in, I don't know, October. So where the downturn, it started to move down, or we had a sideways. From there, for the next 2 months, we had a sideways move, so the upward turn since in September, 1st of September, I think this top from this cycle was predicted ahead of time, and then the market moved sideways until I think October. If you go to so this is the sideways move. So the downtrend was stopped, and then exactly from this point in time, that we had a desync of the cycle. So from October, mid of October, where the cycle started to move down until end of the year, but the market kept holding up. So. And this is a kind of signal that you see that even though this cycle was very stable for a long period of time in the past, that phase changes or the modulation of dominant cycles might start to change. And what I've observed during the last weeks, you see down in the list, there's a cycle of 120 something, 125, I think, in this list here. Yeah, exactly. And with a very low Bartle score. But the cycle lengths with 120, I see showing up on different main data set right now. Yeah, and exactly. And this more and better aligns with the current past. You're right, you see? So the top and the low and the top and the sideways moves. And a low Bartle score is a kind of indication that over the overall data set you use, so from 2017 up to 2021, from a statistical perspective, it's not very valid. But this happens if new dominant cycles show up. Yeah. So the digital signal processing will detect them. So this is why the 125 shows up here. We just need to be careful because over the whole period, this cycle was not there. So it's a kind of new cycle length, which is forming in the current past. And therefore, the overall period, the Bartle score is low. But we now need to have a close eye on if this cycle is showing up more and more on other data sets with this length of 120-25. Even though there is a low Bartle score, we have to keep a close eye on that. And maybe the 173 is more or less from the dominance of this cycle phasing out, and then the 120-something is phasing in. So we have a kind of transition between these two cycles. But
yeah, if I could just make one point on that, it's that when you look at, this has been very, very accurate over the last few years, but if you look at the dominant cycle, which shows up as 119, you see that the dominant cycle was higher during the period the market was higher. So in fact, the composite showed us going down, but yet the dominant cycle was going up. So at least for me personally, whenever I see that type of conflict between where the dominant cycle is going and the composite, then I always tend to view it with suspicion. I don't always trust it as being, all that accurate. So, and other cycles show us to be turning down early this year. So as you mentioned, it might be interesting just to combine a few different data sets to try to figure out.
Exactly. And just to repeat your point, because I think this is an important takeaway, if you have a non-confirmation of a composite and, for example, the dominant cycle here, you can't trust your cycle forecast alone. And that's when you need to have a look and, for example, stress index or the Dow Jones index to validate which cycles show up on other data sets and to invalidate which cycles might not be used here. So that's what you mentioned when you have this non-confirmation by picking different cycles. Yeah, thanks, Mark. So I think that's very interesting, and you're so fast and so quick with the tools. So wow, thanks for sharing, working with it. So it's just fascinating for me and sitting here, and you can run the show if you want.
Yeah, as you can tell, I've had some experience. I've used it for the last few months pretty diligently. I'm trying to really figure out the best way of using all the different time frames and really trying to fine tune how it helps me to be successful. So
yeah, and just let's have a quick final chat. So if you like, we can have final view with your camera. So thanks for sharing your chart here. Yeah, thanks, Mark. So this was great insights how to use it from your perspective. I will pick up some of the questions in the chat in a second, but maybe what do you think we as a foundation, we try to bring kind of easy tools or cycle analysis tools exactly into your hands. I mean, what we as foundation don't do is we don't do market forecasting because we do cycle analysis. So I think this is a great example. What do you think, or what do you need in addition, or how does it help you? So your feedback to the foundation, so in regards using this kind of tools as an open.
I think that honestly, the more data sets that you can provide for the members, I think the more helpful it would be. Like for example, you mentioned that St. Louis Fed Financial Stress Index. I think that's fascinating, and I would love to be able to go back and look at different data sets for different things based on weather, based on whatever I'm looking at, because as we know, it's important to get a couple different things to add some to the conviction and the sort of the confluence of what the cycles might be showing. And so maybe I want weather with natural gas, or looking at different commodities, and that might be helpful. And so all those would be helpful to me. I think right now when you go on, and there's a few different ones you can choose from, and look, it takes time. I think we all have to look at what's working well and what's not, and try to just lots of feedback, and certainly making yourself available for questions, as you've been so kind to answer my questions and feedback. And so I'm happy to obviously give you insight as to what I'm seeing, and would love to be part of the process and helping the foundation continue to grow.
Thanks. So then let's pick up some of the questions. So I think one question also to you, Mark, is now if you have starting to use cycles as you have shown us, how do you start? So do you start with cycles first and then try to find technical indicators, or you first start with technical analysis and then look onto cycles, or vice versa?
Yeah, that's a great question. I don't think it's necessary to have to use one before the other. I just think normally, it's just one piece of the puzzle for me. So if I have a cycle that's worked very, very well, that I know that I've done over the last few months, and it's showing that we're approaching a turn, then I would consider that as being specifically what I would use, and just start with that, and then let other things come into the process. But I personally don't really make use of a lot of fundamentals or earnings or Fed speak, and I consider a lot of news to be largely irrelevant, or not things that really coincide at all with any sort of meaningful terms. I think a lot of that's already baked into the market. It's always very difficult to know the worth of a piece of news in your analysis. It's just, you never know. And so the media every day tells us that something makes something go up, and then when it goes down, they say, well, it's because of this. And it's like, well, wait a minute now, which one is it? Is it right, or is it not? And so with cycles, they're non-emotional. They don't lie. They give you a very accurate way of viewing the world. And I think that's the more that we in this crazy world can strip out emotion and deal with things in a rational, practical manner, I think that the better decisions that we'll make.
Yeah. Thanks. And maybe as you talked about these, what happens in the markets and the news, because there's also questions from a community member about the divergence. We talked about the dominant cycle with the length of 170 something, which was out of sync with the market starting October, November. And the question is, what do you think? Could it be also a possible intervention of the market participants, which try to bring in liquidity injection of monetary injections into the markets? What's your view on that?
I personally don't believe in that. I think, whenever you reach a new stage, somebody always says, well, it's different this time, and look what's happening with the Fed, and that's why the market's moving higher. And I think, look, cycles don't lie. It's as simple as that. I think that, it's always tough to quantify those types of things, like, oh, well, look, this is a new piece of the puzzle, therefore this doesn't matter anymore. And I think that bottom line is, if you use price action like I do on a day-by-day basis, really it's the price that tells you all. And so you wait until price lines up with what the cycles are saying and the sentiment, and that will give you a far more accurate way of how to view the world than trying to guess whether what's the factor that's making something not work? And so, I think that that's all just part of a sentiment equation for me and how I look at it, that it's not,
Yeah, I mean, from my perspective, what's interesting to me is that over the last 20 years, cycles are a leading indicator, as you mentioned. So they are often a leading indicator. They show you in advance from a cycles perspective. And normally, at least at turning points, this goes across the current media news. So when the cycles show you are at a high or approaching a low, this is exactly the opposite what you will read in the media at these point in times because of the exhaustion or what happens. And during these periods, I mean, at least I try to phase out all media news because they just disrupt me from my pure analysis, because then I get trapped by the news infecting my own analysis. So then I trust more the media instead of my own analysis.
Hey, look, all of us are susceptible to the same influence of how news has an effect on all of us, and it's really hard when you're hearing this over and over and over again. You start to believe it, and it's like, it's important to realize that is something that influences us, and the more you can tune it out, the better.
Yeah. So, Mark, I think thanks for having you here for today. We are running now for over 40 minutes, so we just want to keep it close, just have an actual view on the market. It was very interesting for me to have you here to share a little bit how you use cycles in your daily analysis. So thanks for having you here, Mark. And if you want, there's always a place to talk about cycles. So maybe
Thank you very much, Lars. And thanks for everybody for tuning in. Have a wonderful day and look forward to interacting with everybody in the weeks and months to come. It should be a very interesting year.
Thanks, Mark. So let's watch out for that. And thanks. I want to close the session for today, and I would invite you, let's review it next week on Monday. Hope to see you again. Thanks and bye.
Ciao.